Hello and welcome to this special edition of Market Masters. Known for their skin in the game philosophy, PPFAS has built a reputation for transparency, patience and conviction-led investing. Unlike most other mutual funds that offer multiple schemes, PPFAS operates with just one flagship equity strategy, which is the Parag Parikh Flexi Cap Fund. This, I imagine, does greatly simplify the choice for investors and simplifies things for the fund team in their investing as well. It's a fund house which is well regarded by investors not only for how they operate but also for their returns.
PPFAS was also one of the first to give a lot of importance to international investing. In their flagship fund, they invest 65% of the corpus in Indian stocks, while the rest is invested in global stocks.
Well, today we will be speaking with the fund managers at PPFAS Mutual Fund. So let's welcome in Rajeev Thakkar, who is the Chief Investment Officer, Raunak, Onkar, who is the Co-Fund Manager, Equity and Head of Research, and Raj Mehta, who is Fund Manager, Debt. Gentlemen, great to have all of you with us here. Thank you very much. And lovely that we can do this at a critical time for the markets. Rajeev, let me start with you. When one looks at what you've been doing, one thing which stands out is the amount of cash that you're sitting on, which is about a little over 20%, about 22% or so. And this is higher as compared to, say, September last year, even December, the end of December 2024. Just contextualize this for us. Does that reflect a view on the markets, a cautious view on the markets, or, this is just a function of market gyrations?
So, we've had a consistent stance that most of the time we don't have a very clear view on the market, especially in the near term. Our objective is to deploy the money that has been given to us in, let's say, 25, 30, 35 stocks. And as long as we can find those at attractive valuations and have a reasonable spread over sectors and not be excessively weighted in one or two companies or one or two sectors, we would be happy to deploy. What happens is when the valuations shoot up, as was the case last year, that the opportunities are hard to come by. And that's where the cash starts building up. About the question of the cash going up in, let's say, February as compared to late 24, what happens is when equity prices go down, the cash and money market instruments don't go down in value. So automatically the percentage looks higher. It's not that we have been selling more than we have been buying. On a net basis, most days we are buyers in the market. But given that opportunities are tough to come by, there has been some build-up in cash. After the fall that we saw in 25, of course, opportunities have started coming in, and we are looking at other opportunities apart from the stocks that we already own. And I'm hoping that we'll soon be able to deploy if attractive opportunities come our way.
Rajeev, just one question. Do you think, and this is I know, you don't want to commit yourself in the near term, and that's perfectly understandable, but do you think a price bottom after the correction that we've seen is in place? Price-wise, we've seen that low below the just under 22,000, and that will hold now.
So, see, we could toss a coin and judge whether we are at the bottom or markets will be up or down. But let me give you some data points that I am watching and which would give some inkling of where I see at least on a valuation perspective or from the demand supply side kind of readings that we are getting. So recently there were, I think, money control at this event where there was a panel discussion on the IPO market. Now, a number like 5 lakh crores was spoken about. That is the kind of fundraising that is expected from the market. So this is not a small number. At the same time, regular supply keeps coming because ESOPs get exercised, those employees sell shares in the market, QIPs and rights issues keep happening. The older shares which are issued and which are under lock-in, those come out of lock-in and people sell. Also in terms of the valuation parameters, although we are better valued now than we were, let's say 3-4 months back, but are we at cheap valuation levels? Answer is no. Is there still froth in large pockets of the market? I think the answer would be yes. So bottoming out will happen, I think, stock by stock and sector by sector, rather than the overall market bottoming out. So you could have this strange situation where some stocks look attractive and people will start buying them and they could stabilize or start moving up. At the same time, segments which are very, very frothy could see a sustained price correction over a point of time.
So we'll get to where perhaps we've seen a bottom and where there is still some froth in just a bit. But let me also welcome Raunak and Raj into the conversation now. Raunak, so since you all invest about 35% of your corpus internationally, now the question is, has US markets hit a peak? Chinese tech stocks like BYD or DeepSeek have questioned US exceptionalism. You visited China very recently, I think at the beginning of this year. So first, give us your thoughts on the US mega cap stocks. Have they hit a peak? What happens to US exceptionalism? And then US versus China.
Thanks, Reema. Just to give you a correct data point, the overall exposure for the foreign stocks in the portfolio in FlexiCap fund is about 12%. The 35% limit you mentioned is the overall regulatory limit up to which we can invest. And at peak times, we have been somewhere close to about 30% of the fund. But I think since February 22, RBI restrictions have come across to all the AMCs that we cannot repatriate new funds to invest in global stocks. That percentage has been coming down for us as more and more fresh investments have been going into domestic equities. So that's the reason why the percentage is at about 12% for the international stocks. To come back to your question on the US mega caps, so we own 4 of them. We own Amazon, Microsoft, Alphabet, and Meta. And when we bought these companies, the idea was to get a cross-section of different segments in the US tech space. And if you look at technology as a whole, we would like to invest in technology-enabled companies, and they also have their own technology products that they sell. So here we see digital advertising as a space where there's a very strong tailwind of operations growth over a period of time, and that segment also is taking market share from traditional media in many parts of the world. So that segment has been growing well, and these companies have been demonstrating very well. A large portion of Meta's revenue comes from digital advertising platform that they run. A large portion of Alphabet's revenue, Google's revenue, comes from the digital platform that they run. Also, the cloud computing space has been picking up a lot lately. So if you see the IT demand and enterprise demand from cloud computing has been steadily growing over the past decade plus. And that tailwind also has been helping the top players like Amazon, Microsoft Azure, and Google's cloud business that is running. The other part is even the consumer software or the enterprise software part of Microsoft has been doing well as the number of seats have been growing over a period of time across various products that they sell. The SaaS ecosystem has been growing for these companies as well. Even Google has a business in that regard. And if you look at the overall e-commerce penetration in global markets, especially in developed markets, that penetration also has been increasing over a period of time, benefiting an online retailer like Amazon, which also has a third-party seller business. So these are all great tailwinds to have to participate in over a long period of time. And what interestingly happens is these businesses generate so much cash flow that these cash flows can be deployed into R&D for new research, for any other optionality that we can get, which is not something we are paying for, but we are essentially participating in a successful business which is generating operating cash which can be redeployed into interesting opportunities. So that's what's happening in some of the areas. And you mentioned about China and the ecosystem over there. So my visit was in October last year, and the whole idea was to see how the technology ecosystem for electric vehicles has been growing over there, and got a good small cross-section of companies to understand what is happening. And it's very different from what is happening even in the West, developed markets, and even our country for that matter. So I think a lot of businesses in the short run might underappreciate the importance of R&D, but in long run the R&D really helps to scale up efforts and have a optionality of different businesses that they can run.
Have you invested in China, Raunak?
We haven't been. I think from international investors' point of view, China is a very difficult market to invest in. Not because there's a lack of opportunity and valuations are interesting, but The way outside investors invest in China is through something called as a variable interest entity, and these are holding companies listed out of places like Cayman or any offshore countries, and these are the ways outside investors or non-Chinese investors can invest in technology sector in China. So that is a big challenge because you don't get the direct underlying holding for these companies to invest in. So far it has worked. Over the past 30 years this concept has worked. But it's a very one-off kind of a situation where you're not directly owning something, when you have to buy a piece of paper which says that, hey, this is a way you can invest in a country where the regulations and restrictions on the stock market or some of sectors are very difficult to come by.
Raj, US economy, there is considerable fear of it slowing down. There is talk of fear of a recession or stagflation. You look at the macros very closely. Is that a big risk globally?
We track macros, but we don't track it in such detail. So the top-down matters, but what we look at is evaluate companies on a bottoms-up basis, evaluate whether the investing in businesses makes sense or not. So coming to US, so Fed held rates yesterday and said that a couple of rate cuts will happen this year. But broadly, if you look at post-global financial crisis from 2009 till about 2023, the interest rates were kept very low. They kept printing money. So now that era is over and we are moving into higher interest rate scenarios. We are moving into a world where tariff makes headlines almost every day. So volatility will be there. Global macros may be volatile over a period of time. And having said that, our focus is always on evaluating businesses on a bottoms-up basis, though we keep a view on the macros.
You know, since we are on the subject of the US, and just to sort of finish that point off, Rajeev, you know, 2nd of April, they've said the US is going to hand over a tariff number. And of course, Mr. Trump has complained about high tariffs here in India quite a bit, maybe more than any other country apart from China. I mean, I know you do with, you know, it's all stock specific, bottom up, but any sense on what, if the number is a high enough number, what parts of your portfolio are impacted? How do you think about this question?
So I have not been worrying too much about this, Prashant, because firstly, the exact policy is unknown. So one day tariff is on, another day tariff is off, then there are some exemptions and carve-outs, and then again the temper tantrums happen, and then the tariff is back up again. A lot of our companies are either participating in the domestic economy, or wherever they are even exporters. In many cases they are exporters of services, or we have some exposure, let's say, to generic pharma companies, where these are essential things. So I don't think tariff one way or the other will impact the volumes and pricing to that extent. I think net there is realization everywhere that sudden knee-jerk reactions of very high tariffs is not going to create capacity overnight in the US, and ultimately the consumer will suffer. A lot of this, I think, is posturing, trying to get other people to balance their economies. So you spoke about China. The measures in China are to increase domestic consumption and domestic economy rather than just depending on exports. So Mr. Trump is right in that sense that US cannot be a trade deficit company forever for very large amounts, and ultimately some rebalancing has to happen, and that will happen. But let's say even if tariffs are brought down on something like a Tesla, will it change the auto market domestically very dramatically? Unlikely, because they operate in a very high price segment. So adjustments will happen. Will it be a very different morning on 2nd of April? I have my doubts. I think more or less it will be business as usual.
All right, we'll take a quick commercial break here. So much more to talk about. So that's interesting. Will the 2nd of April or the 3rd maybe for, you know, will it be a very different morning here? and around the world. Rajeev essentially saying that maybe not, but interesting perspective nevertheless. We'll continue this interesting conversation with the team at PPFAS Mutual Fund. Take that break. See you on the other side.
Welcome back. You're watching our special show, Market Masters, and we're in conversation with the top team at PPFAS Mutual Fund, Rajeev Thakkar, Raunak, Onkar, and Mehta. Rajeev, you told us earlier that the market doesn't bottom out at the same time, the entire market. Some stocks may have already bottomed out and opportunities have started to come in. So incremental cash, where are you deploying? What is the team buying right now?
So far the buying has been in spaces where we already own positions. So for a long time we have been liking the banking and financial services names. So we have been owning 4 private sector banks, and those have been things that we have been buying. We have been, as would be seen from our February portfolio disclosures, we have added positions in some of the auto names that we have, or the public sector companies that we own, or in the pharma companies that we own. Largely it's been the same names. In December and Jan we added a couple of new names to the portfolio, but those are the places where we have been deploying.
Financials. What about IT, Rajeev? Is that an area you like? It's a bit of a non-consensus view.
So in IT, there are multiple reasons to be concerned about, but at the same time, longer term, these companies have been well governed and have been generating a lot of cash flow, etc. So one of the big concerns in IT has been around this role of AI in coding, and how much of an impact there will be on the number of people required and the IT budgets of various companies. That has been one area of concern. The other area of concern has been this accelerating trend of large foreign companies setting up their global capacity centers in India and directly employing people rather than going through the listed IT companies. And the third, of course, has been this new regime change in the US, and what will that do to visas and offshoring and things like that. So various concerns have been there. However, the companies in India have had a track record of managing various challenging environments. So we are neither too optimistic on this space, nor are we completely down and out. It's somewhat of a neutral stance here.
Raunak, what has made you all incrementally more bullish on autos, PSUs and pharma? These are the 3 sectors apart from financials, which is pretty much a consensus on account of valuations. But what has made you incrementally more bullish in the month of February?
So in the auto space, if you look at the domestic auto market, it's in fact a very small market compared to some of the global markets. In a country of size of India, we have a very low auto penetration. That has been the longer term trend which has been captured by some of the domestic players who have built the manufacturing capability in India. They understand the domestic market very well and what kind of products are being bought by Indians. These kind of products are launched by these companies. Whereas if you've seen many of the foreign companies in India, they've not been able to scale except for one player at a meaningful rate in our country, because it's a very cost conscious and a feature conscious market. And that's a unique thing about India, where if you have built an expertise to make in India, to service in India, and also to provide a new innovative product lineup over a period of time with all the safety and price considerations, I think that is a skill set good with the Indian automakers. That's what made us conscious about the opportunity here. At the same time, the company we added, Mahindra & Mahindra, is not just into passenger vehicles. They're also into farm equipment like tractors. They're also into IT services. As a conglomerate, they have been doing a lot of cleanup over the past from capital allocation point of view, and the growth from some of the segments that they operate is also quite positive. So we own a couple of them. We own Maruti Suzuki and we own Mahindra & Mahindra in the auto space. In the pharma space, Reema, essentially it's a basket of pharma stocks. It's not a sector where we are bullish on a particular company, but the way we have been buying these companies is on the back of the tailwind of generic drugs exporting over a long period of time. And India has a capacity and capability of marketing and selling these drugs across the world. And they also cater to the domestic market, which is also growing at a faster rate. So these trends, if you combine across multiple companies, we don't need to pick a single company where the risk of FDA warnings or import alerts can hamper their profitability. But if you build a basket of such companies who have similar characteristics, a good balance sheet strength, capability of marketing across the world and even domestically, I think these companies provide a good diversified way of investing in pharma space.
Got that. Rajeev, you used to own Indraprastha Gas, right? But I think you sold that name when the APM gas allocation rules were changed. But cities still do need gas distribution, right? It's still how are you thinking about that space? Stocks, of course, have corrected quite a bit.
Sure, Prashant. So there have been 2 or 3 points which create a lot of uncertainty. One, of course, is the APM gas allocation. The other was around how much profits these companies should be allowed to make. So there were statements from the regulator and from the minister. So that again creates this uncertainty and overhang. The third important thing, since you mentioned specifically Indraprastha Gas, not that we own it or we have any strong view about it, but again, in the media, there have been statements from various authorities saying they want to convert the transportation market in the National Capital Region to electric vehicles soon, so that the pollution levels come under control. Now, that directly hits at the large CNG market in which this company operates. So I have no idea as to when these things will happen, or is the stock attractive enough to buy or not. I don't have a specific view on that, but there are these few factors which are an overhang on the overall environment.
So much change and so much disruption, right? I mean, you own, I think you do own Mahindra & Mahindra in your portfolio, and they are partnered with BYD for their batteries, I think. And BYD yesterday came out with this 5-minute battery charging system. Time taken equal to sort of filling up your car with petrol or diesel. I mean, so it kind of could be an inflection point. But again, I mean, what does that do? When is the question? What does that do to industries like, refining? And so lots of implications which will play out in the coming years, Rajeev. Do you think the rate of change in terms of disruption has picked up quite a bit?
Yeah, I think the only constant will be change and at an accelerating pace. So we have seen this in the way people transact. So the whole UPI and the fintech ecosystem that has come about, the e-commerce, quick commerce, the gig economy, ride hailing, transportation of energy, transportation shifting from internal combustion to EVs, the energy use itself, the pickup in solar and wind over the fossil fuel led power generation. So plenty of change. As you rightly said, one will have to arrive at judgments in terms of which are the companies which will be able to make the transition and which are the companies which will fall by the wayside, and at what pace the transition will happen. Being too early also can be damaging, and being too late also can be damaging. So one has to time the transition well.
Raj, the optimism on banks also stems from the regime change at RBI, the recent liquidity bazooka, expectations of rate cuts. So valuations aside, what are you all expecting from the RBI and the macro indicators?
So very difficult to predict what the RBI will do, but broadly, if you see the measures that they have taken to improve liquidity, be it open market operations or be it dollar-rupee swaps, From an inverted yield curve, we have moved to a flatter yield curve now. So the shorter term rates have moved down a little bit. But going forward, we expect the short-term rates to move down a little more, whether it will happen in the next monetary policy or after that. But in the calendar year 25, we expect the short-term rates to be softer than where they are right now. And it will move to a more of a normal yield curve that it used to be 2 years back. So that's where we see the interest rates moving.
Okay, well, more questions, but as always, we are paucity of time. Raj, Raunak and Rajeev, thank you very much, all three of you, for sitting down with us here at CNBC-TV18. An interesting conversation. I hope the one of many that we will have over the sort of coming months and years as we track the changes in many of these industries that we discussed. Thank you very much for being here on this program. We'll take a quick commercial break here. We continue with the regular programming on the other side. Stay tuned.